ETF investing never stops evolving and now goes far beyond passively tracking index returns. Find out how our active fixed income ETFs, backed by deep research from Manulife Investment Management, can help you be better prepared for whatever lies ahead. Learn more at jhinvestments.com/ETF.
This is Exchange Traded Fridays, brought to you by ETF.com. I'm Sumit Roy, Senior Analyst here at ETF.com, and we have a very exciting episode for y'all today. The Fed just cut interest rates by 50 basis points, an emphatic move that's designed to keep the economy humming along. What does the rate cut mean for stocks, bonds, and ETFs in general? We're going to be diving into that with some of ETF.com's writers, as well as a couple industry experts. On today's podcast, we have myself, editors Ron Day and James Rubin, as well as wealth management editor Jeff Benjamin. First, we're going to be joined by Brian Jacobson, chief economist at Annex Wealth Management, who's going to break down what the Fed decision means for your portfolio. And then later, Charlie Travers, portfolio manager at Motley Asset Management, is going to chime in on the Fed and tell us a little bit about the Fool's unique lineup of ETFs. So without further ado, let's get into it. Brian, great to have you on the show on such an eventful week.
Yeah, thanks for having me. It's been a lot of fun.
Absolutely. So let's start at the top. What do you think of the Fed decision? Was it a surprise for you?
It was a little bit of a surprise for me because I was expecting that they would do 25 basis points for the cut with a strong signal that they are going to do a series of 25 basis points cuts and perhaps change their quantitative tightening. Instead, they decided that they would do the 50 basis points. And that did take me a little by surprise, but it seemed like, Chair Powell was trying to clarify throughout the press conference why they decided to take such a big bite out of the Fed funds rate target all at this one meeting.
What was Powell trying to say? Because, I'm reading some things, people are just like, the markets tanked right afterwards.
It was fun on our investment committee because we met prior to the meeting and we were all discussing, okay, so what will the statement say? And then how will the markets react? And some people were saying that they would do 50, some saying 25. And then as far as the trajectory of the markets, it was kind of an agreement that, well, it'll either go up and then down and then end flat, or it'll go down and then up and end flat. And so we did get really that almost near flat outcome on the day, but markets have gone on a tear. I think that Powell, it's really difficult to find out what he really was saying. I think he showed how he's a lawyer. He was talking out of both sides of his mouth because at the beginning, he said that you can take this as a sign of our commitment to not get behind the curve. But then later on, he said that if you ask, if we had gotten the July employment report before the meeting, would we have cut? He said yes. So in a way, he was saying that, nope, we're not behind the curve. We're trying to get in front of it. But then he admitted, no, we're a little behind the curve, but only a little.
Which scenario is markets buying? Investors they had to pick between one or the other, right? And they picked.
I think they picked the first one. Yeah, they picked the more optimistic one because in the past, if we look at other scenarios where the Fed has cut rates and we didn't go into a recession, I look back at 1995 as an example of where they cut, they were viewed as being proactive. They were ahead of the curve. But then we look at, I would say 2019 was an example of when they were behind the curve. We did not have a soft landing because of COVID. We probably would have had a soft landing, except for that COVID hitting. And so, but they were viewed as being behind the curve. The market reaction was very different in each one. When they were ahead of the curve in 95, S&P 500 did quite well. Yields moved up a little bit. In 2019, they were viewed as being behind the curve, and the market sold off. Yields fell because it was viewed that growth was slowing too rapidly. There was too much momentum. And I think that the market has just decided to embrace that 1994 narrative more than the 2019 narrative. And I fear that, the day after the cut, that the market is saying, yep, okay, it's great. Those initial unemployment claims numbers, they came down, things are fine. But suddenly we're going to probably get some negative data release that's going to draw that narrative into question. And we can very rapidly then shift to the more 2019, where the behind the curve narrative.
So there's still the potential for a lot more, uncertainty in the market. I mean, there's always uncertainty, right?
Oh, yeah. And that's what markets do, right? I mean, markets, a lot of people like to say markets don't like uncertainty, but we kind of do, because without uncertainty, there really wouldn't be trading. There wouldn't be abnormal returns to be had. You have to have that differentiated view. Uncertainty is really what we price day in and day out, and how you try to do better than average. But there, I think, is that hyper dependence on every data release still, where until we get a little bit clearer reading about, is the labor market really going from hot to tepid to cold, or is it going to stay at this tepid reading that we currently have? Until that gets a little bit further resolved, I think that the market is going to swing between big up days like we have today and some possibly big down days that are likely going to happen at some point soon.
So, Brian, we have talked a lot about the market's interpretation of the Fed move, and I want to talk a little bit more about the stock market in a second. But what's your take? Do you think the Fed cutting by 50 and signaling that it's going to keep cutting changes anything for the economy? Does it make a soft landing more likely in your view?
I was expecting them to do the 25, and whether it was 25 or 50, ultimately for the economy probably doesn't matter. I think it matters a lot more for the markets as far as, did it meet or fall short of expectations? In terms of the economic effects, I'm actually somewhat fearful that a lot of the higher end, higher income consumers have been really propelling consumer spending over the last, say, 6 months. They're the ones who don't have debt. They have net savings. Now, all of a sudden, they're going to earn a little bit less on that because as rates come down. And so are they going to cut back just a little bit? Not a lot, but just a little. Whereas the relief that lower income households, smaller businesses experience, that's going to take time to play out as people figure out, does it make sense to refinance? Does it make sense to take on, a new project? And so I fear that we can get a little bit more economic pain before we experience the gain from the rate cuts. But broadly, I look at the world through kind of the lens of the fundamentals, valuations, and then what's going on from a trading perspective. The fundamentals, I think the Fed is a little behind the curve, but it's not as bad as in previous periods where it led to recessions or we're in recessionary periods. So fundamentals, I think, are okay. They might strain a little between now and the end of the year, but they'll hold in there. Valuations are elevated, but I don't think it's really across the board. When I look at small caps, mid caps, value stocks, more cyclical, that's where the valuations, I think, are okay. They might not be fantastic, but I don't think it's at worrying high levels. But then I look at sentiment and the trading activity. That's where I think that's going to drive the market in terms of, this kind of shifting of the narrative from the soft landing behind that they're ahead of the curve to the harder landing, they're behind the curve.
Were you surprised by the dissent? I think it was Michelle Bowman,
yeah,
who preferred the 25 basis point cut.
No, that was the one thing I got right in my predictions as far as what was going to happen. So I did, my team, talk about how this is likely going to be the first meeting since, I think it was June 2022, where there was a dissent. At that point, it was Esther George. She wanted the Fed to not hike quite as quickly. And then it's the first time that a governor has dissented since 2005. But I was expecting Bowman was going to dissent based on things that she has been saying just prior to it. She isn't one of them that's been out there quite as often as some of the other Fed officials. But I kind of figured that there was going to be at least one person who was going to actually dissent. Now, and I don't know if this is still true, but one of the things I was taught many years ago is that when they go around the room to vote on the policy, they do it in alphabetical order. And usually when there's one dissent, that nobody else dissents, because it's like, one is enough. The other people, they don't have to really pile on. And so her last name starts with a B. So maybe she was the first one, the chair voted, and then they go alphabetically. And so then she dissented. And so maybe others would have dissented, but didn't, because one of them was already registered.
Interesting. That's really interesting. Hey, speaking of politics, this is kind of a political blush. Which presidential candidate, if you can even make an assumption, who do you think this will benefit more? Does this help the Trump campaign or the Harris campaign?
It all depends on how it's spun, right? That's the interesting thing about politics is you can spin things whichever way you want it to. I think that the balance is it would likely help the Harris campaign. I think that Trump has already come out, even before the decision came out, saying that this was going to be an attempt to help Harris. In a way, it's a way to deflect responsibility and to be able to preemptively place blame. As far as if something doesn't go right, you can at least say, "See, I told you this was due to the Fed." But in terms of the actual economic effects, I don't think it helps either one of them, because monetary policy doesn't operate quick enough in order to actually help the economy this close to the election. I think it would have been a little bit different if we were talking about rate cuts back in, say, November of last year, as opposed to during the summertime.
Yeah, that makes a lot of sense, Brian. I kind of want to ask you about the economy. You touched on the initial jobless claims we got this week, and those were lower than expected, but we've also seen the non-farm payrolls come out. They were weaker than expected, and we saw that huge downward revision for job growth over the past year. On the other hand, GDP is tracking at something like 3%, and we've gotten a couple of quarters now of strong GDP growth. What do you make of kind of these contrasting economic data points?
Yeah, when you get messy macro data, you get these mixed messages, you get messy markets sometimes. And we got the retail sales numbers, which were slightly stronger than expected. You had the National Association of Home Builders, their optimism index improved a little bit. Industrial production increased a little bit. So we've gotten some recent data. I think those are three key ones that helped improve the nowcast and the real-time tracking of the economy, as reflected in whether it's the Atlanta Fed's measure or the Dallas Fed. They have their weekly economic index that I also like to look at, and those have improved, I think, because of we had a soft patch in July as far as with the data, and then you had a pretty decent bounce in August. I'm not sure there's going to be a real strong follow-through with the September numbers, though. Some of what we have seen for the year so far, we have to keep in mind that this looming port strike on the East Coast has led a lot of retailers to front load some of their orders to make sure that their shelves are fully stocked when we approach the holiday shopping time. And so I think that you have had a couple factors at play where retailers trying to front load orders, that has propped up growth a little bit. We had a soft July, a decent bounce in August. Maybe we'll get some payback when those September numbers come in, but the September numbers don't come in until October, right? And so that's one of the problems with some of the macro data. It is so backward looking with these lags that happen, also subject to revisions. The big downward revisions in the employment situation report, that definitely got Chair Powell's attention. And I think this is highlighting one of the problems with monetary policy. If you think about last year, when he was trying to justify the rapid pace of hiking rates, he pointed to this change in the University of Michigan's Consumer Sentiment Index, where there was an upside surprise with people's inflation expectations. Well, subsequently, that was revised away. They've been really hanging their hat on a strong labor market for the past year. Well, now with the August numbers, that was revised. 2/3 of the job gains over the last couple of years have been revised away. And so highly data dependent Fed, I think, is actually somewhat dangerous here.
Brian, what are you generally saying to clients today?
A lot of them are asking about the upcoming election and finding out about there's anything that they should be doing with their portfolios. And, when you look back at history, there's different patterns that you can see in the data, but those patterns don't play out every single election, right? A lot of people look at the averages and they say, hey, they want to invest based on that in this particular election or this particular time of the, say, monetary policy cycle. And so I've been trying to just coach them about, let's stick to the plan, stay diversified. There are still, I believe, opportunities out there that if people have been cowering in cash, the Fed has kind of rung a bell saying that those really high yields that you can get on high yield savings accounts or on money market accounts, they're still there, but they're not going to be there forever. And so let's look at opportunities to allocate more back towards the plan. Near term, I really like the outlook for credit. Equities, we are overweight equities across our model portfolios for in small and mid cap areas, especially. But when it comes to corporate credit, I think the quality of the issuers in the corporate credit space is better than we have had in a while, somewhat justifying these narrow spreads. And so one of the ways in which I think you can dip your toe back into the water to take on more risk isn't necessarily to go, head first into equities. It might be more tiptoeing in through investment grade and high yield credit.
Are your clients receptive to this message? What's the tenor? Are they angst ridden or as I said a moment ago, sort of receptive to what you're telling them about this sort of pivot?
Yeah, it's generally receptive, especially since the all-in yield that you see in the high yield space is basically the historical average for what equities have returned. Which, I mean, the thing with the average, though, especially with equities, is sometimes it's a lot higher, sometimes it's a lot lower. It's never exactly average. But when they say, okay, I can see some high yield bonds that are out there between 6% to 8%, and that is aligned with their financial plan, they find that to be a little bit more encouraging as far as trying to allocate more there. But when it comes to trying to get into equities, a lot of people still are very nervous about the political outcome as far as what we might have. And that's where I think it's a little bit easier to think about credit as opposed to all in on equities.
Where do you see rates going in the next 12 to 18 months?
Yeah, it depends on which rates, right? So if we're talking about the federal funds rate, short-term rates, I'm going to take the Fed at their word that probably, let's say, 18 months from now, or maybe it's even 12 months from now, we're going to be closer to 3.5%. Maybe it's going to be 4%, 3.5%. But then when I look at, say, 2-year treasuries, 10-year treasuries, around 4%, I think is pretty fair. And so it's slightly higher than where we are right now, where the 10-year treasury is closer to about, between 3.7 and 3.75%. And so when I'm looking at rates from that perspective, as far as, okay, cash rates coming down, but then what you can get on treasuries, maybe about where we are. And then looking at investment grade, that's a little better. And then looking at high yield, provided that you're not scraping the bottom of the barrel, that's actually a pretty generous all-in yield right now.
What could change that scenario for you?
The biggest one would be if we get a more rapid pace of economic slowing. In those scenarios, then all of a sudden credit spreads, especially on the high yield side, those blow out. I mean, in every recession that I have seen, you do have where the credit spreads, when they widen, it's because those corporate yields are moving higher and treasury yields are moving lower. And in that regard, I think that if I were to see these initial unemployment claims numbers begin to move up towards, let's say, 250, 275, right now we're close to 220. But if I see that on an upward trend consistently over the course of a number of weeks and not necessarily just 1 week's data release, if I see that beginning to move up, breaching that 250 to 275 level then I'd probably pull back a little bit as far as what I have in terms of that high yield exposure.
We headed for recession?
Eventually, but probably not this year. So recessions, they still happen. The business cycle is not dead, but I think that the Fed is going to be able to pull off this soft landing, albeit perhaps with a little bit of market turbulence here and a little bit of continued weakness or weakening. But I don't think the weakening is going to turn to outright weakness for the overall economy. If we do get a recession, some of my expectations are more of it's because some excess has built up that needs to be worked out. And given how conservative a lot of chief financial officers and chief executive officers have been over the last year and a half or so, it's almost like they've been bracing for a recession that has not shown up. In that situation, it's hard to see where the economic excesses have really built up to the point where it really needs to have some sort of correction that only a recession can fix.
Brian, before we let you go, I have to ask you about the stock market. We're recording this and the S&P 500 just hit a fresh all-time high. What do you think? Do you think the S&P can keep rallying? And then also I want to ask you about the rotation. All year long, we've been hearing about how rate cuts are going to disproportionately benefit small caps and equal weighted S&P 500 type of ETFs. Do you agree with that?
I do agree that the rotation will happen, but it will happen probably when people least expect it, and it'll happen faster than people are expecting. It's one of those where when I look back at history as far as what has happened in terms of, let's say, equal weight versus market cap weight, small caps versus large cap, the catch up of small caps can happen ferociously, very rapidly. And so I do expect that it will happen. It's probably going to be disappointing where you see that, oh gosh, the NASDAQ is still the one that's leading the charge. When will small caps have their day? Well, someday it'll happen, and it might take place over the course of just maybe a few days. So it's one of those where it's going to be painful to hold those, but at some point it will happen. What could trigger it? My guess is that we will see as we approach the election that people will start getting more optimistic about the resolution of the election. We'll also be at a point where we will have be going through earnings season once again. And it's really, I think, maybe some better guidance from some of the small cap names where you could see that big clustering of suddenly rapid outperformance of small caps relative to large caps, but it is still a waiting game.
Fantastic. Well, we're going to have to leave it there, Brian. It's been an absolute pleasure having you on the show. Thanks so much for your time.
Thank you. I really appreciate it.
Jeff, that was some great stuff with Brian. Why don't you kick off the next segment?
Okay, up next, we're speaking with Charlie Travers, portfolio manager at Motley Asset Management, who is going to tell us about his ETF lineup. Charlie, welcome to the show.
Thank you, Jeff. Happy to be here.
Yeah, glad to have you here. We want to talk about your ETFs, but first we're going to get into some of the news this week. The Fed, I'm sure you heard about it, announced a 50 basis point cut in interest rates. Did that move surprise you at all?
It did a little bit, Jeff. I was thinking it might be 25 this time around, but they went for 50. And, the market's responding nicely this morning.
Absolutely. So, Charlie, I want to get into your asset management business. A lot of listeners, they're well aware of the Motley Fool brand. You guys are, well known for your news analysis and stock tips and things like that you provide on the fool.com website. But not everyone knows about your asset management arm. How long have you been in the ETF business?
Well, we launched our first mutual fund back in 2009, right after the financial crisis, based on demand from our retail audience who liked the stock picking the publishing side of the business was doing, but was asking us if we could do it for them. Now, if we fast forward a few years, we launched our first ETF, TMFC, in January of 2018. And then following that, we launched a few more, but we also converted those old mutual funds into ETFs to where today we have a total of 6 ETFs in our lineup. 3 of those are are passive index ETF products based on the intellectual property of the publishing company. And then 3 of the ETFs are actively managed with our own stock picking from the team of investors I work with. And there's 10 investment professionals total who are making those stock picks and running those ETFs.
What's your most popular ETF? And can you tell us a little bit about it?
Yes, Jeff. The flagship product for us would be the Motley Fool 100 Index ETF. The ticker there is TMFC. It is based on the stock recommendations of the publishing side of the business, which are assembled into a market cap weighted index and rebalanced quarterly. So with one, ETF ticker, it lets financial advisors and retail investors buy the stock picks of the Motley Fool. It's been a very popular product for us, and it's knocking on the door of $1 billion in assets.
So, Charlie, it looks like this is technically an index ETF, but it's really an active ETF under the surface. Is that right? Since it depends on, the research and stock picking abilities of Motley Fool analysts.
It's a unique product in that regard, as you mentioned, where the index itself is based off of the analytical work of the 40 analysts who work for the Motley Fool publishing company. But then the ETF itself is a passive full replication of that index. So when it changes quarterly, the ETF changes as well. And I am the portfolio manager on that product, responsible for making those changes.
It looks like a pretty tech-heavy ETF. Where are you, Charlie, as far as the continued strength of tech stocks?
Yeah, so it is. It slides right in between the S&P 500 and the NASDAQ when it comes to that tech weighting and the growth profile. I am bullish personally on the prospects for tech going forward. I think that's one of the strongest growth areas of the market. Sure, there'll be some volatility and some up and downs, but we are long-term, buy and hold investors at the Motley Fool. And if I look out 5 to 10 years, I'm definitely a believer in what tech's going to do.
Speaking of tech, Charlie, AI, that's been the theme of the year. How do you see AI impacting your ETF and the stock market at large? Some have said, the impact from AI on revenues and earnings, other than for NVIDIA, have been modest so far. Do you expect that to change?
Yeah, I think it's going to be transformational for businesses in general. It can add a lot of capabilities to firms with how you interact with your clients, product development, et cetera. I think businesses that underinvest in AI and the tools that come along with it are going to be left behind. So it's not just the chips. I think it's going to affect all aspects of the internal operations of businesses and how they interface with their customers and meet their needs.
And Charlie, we've talked about your most popular ETF. Could you quickly give us an overview of the other ETFs that you manage?
Yeah, so the 2 other passive products, one is another large cap growth index, but unlike TMFC, it limits the position sizes to 4.8%. So you don't get those runaway mega cap techs taking up a big chunk of the weight of the fund, which appeals to some advisors who want less volatility. We've also got a small and mid cap index product that comes right under TMFC. TMFC would be the number 1 to 100 companies by market cap. TMFX would be 101 down to 300 for investors who want small and mid cap exposure. And then on our actively managed side, we have our Global Opportunities Fund, which has a nice breakdown today of 60% in international markets, 40% domestic for investors who want some international exposure. And then we also have actively managed mid cap and small cap growth ETFs, because we feel that's an area where old-fashioned fundamental research can pay off.
Charlie, I've been around long enough that I still think of Motley Fool for their content and the way you guys built up from there. How has that media presence helped you in attracting assets to your ETFs?
Well, the Motley Fool is a 30-year-old company at this point. It's making stock recommendations for decades to a retail audience, and we've built up a pretty good brand reputation and a track record with individual investors. And up until very recently, that's been the bulk of the assets we've been able to attract into the ETFs is from those individual investors who are long-term customers of the Motley Fool. And now that we've built up some critical mass with our assets and built, track records we can point to, we're getting a lot of positive reception with financial advisors as well.
Okay. Good stuff, Charlie. Thank you for being here. We're going to have to leave it there for now, but thanks for joining us.
I appreciate the time and the conversation, Jeff. Thank you very much for having me on.
Okay, and I also want to thank all of our listeners for tuning in to Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcast. If you have a question or want to share some thoughts or join the conversation with us, you can find us on X. The handle for ETF.com is @ETFTom. We'll catch you next week. Thank you.